Bismillahirrahmanirrahim. Assalamu alaikum. I am Sayyid Akif Shah, Lecturer Finance at Institute of Business Studies, Kohat University of Science and Technology. The title of this course is Intermediate Accounting. The course code of this subject is BS 363. This is lecture number 13, and the topic for today's discussion is accounting treatment for debentures. In our previous lecture, we have explained the classification and the types of debentures. Basically, this lecture is in continuity to the lecture number 12, and particularly in this lecture, we will deal with the accounting treatment for debenture issuance. The outline of this lecture comprises of the following agenda, which is to explain that after listening to this lecture, student will have the grip on the journal entries for the debenture issuance under the category A from the consideration point of view, under the umbrella of which we will have three different categories and techniques for writing or recording the journal entries. So after listening to this lecture, the student is assumed to have grip to generalize the entry for three categories, which are as under number first, for consideration other than cash, which is to explain that when the company issued the debentures, it does not take cash, rather it takes some kind of assets which is other than cash for the company. Like for example, if company is looking to buy a machine from a vendor, so rather than to pay cash to the vendor, it can simply issue debentures, which is a debt instrument, to that vendor in order to buy the machine. The second category is for consideration in cash, which means that if a company is looking to purchase a machine and the company is not going to pay the cash, rather I must say that the company is issuing the debentures. It has nothing to do with the machine buying or selling. We are discussing the debenture issuance. In the first case, we were considering or issuing debenture against the asset, which could be a machine or any other asset. The second category belongs to the issuance of debenture on cash. Simply you can issue debenture and collect the cash, which will be treated as a debt capital for the company. And finally, we can also take a direct bank loan from any banking organization, and we can simply put the debenture as collateral for that loan. Like in order to give a security to the banking company regarding the payment of the loan amount, company can simply issue the debentures as a collateral for the loan amount, which we will discuss in detail in a practical example in our upcoming lecture. This is the first condition, that is for consideration other than cash. Like the company is issuing debenture, but it is not asking for the cash, rather it is asking for some tangible asset. So what could be the accounting entries under this phenomena? The company will record two journal entries. Number first, it will debit the sundry asset account, like whatever the asset company is looking to buy. Write down the name of that asset, like sundry machine account or sundry asset account, and debit it in its journal. And the second entry, according to the double entry accounting system, is to credit the vendor account. Now the vendor here is the supplier of that asset. So you can simply write down, if for example you are buying a particular asset from Mr. Ali supplier, so you can write down to Ali account as credit, and then give a shortest narration as a tradition of accounting journal entries must be in the small brackets, and a shortest, precise and concise statement being the purchase of asset. Subsequently, you are required to make another entry, that is to debit the vendor account previously credited. In our first entry, we need to vanish or just remove and write off this account. So in order to remove and write out the temporary account from our journal or journal entries, we need to give counter adjusting entries. Like here, if the vendor account was credit, so in order to remove the credit balance, we need to give a debit entry over here. So subsequently, we did the same, vendor account debit, and the original liability account has been generated, which is to the debenture account. Debenture account is actually the liability account which is mentioned in the balance sheet under the liability section, and we know very well in the basic accounting and the journal debit and credit rules regarding the liability is that increase in liability is recorded as credit. So the company's liability has been increased because it has issued the debentures to the journal, to this vendor, not journal public, this vendor to purchase the asset, particular asset the company is looking to buy. So therefore a liability has been generated in the books of account, and in particular in this case the liability is debenture. So therefore the debenture account will be credited. And once again a shortest narration, which is being the issue of debenture. In case if the debenture are issued at a discount, not on the par value, discount mean if the debenture is of rupees 100 and it has been issued as rupees 90 per debenture, so then the debenture will be considered as sold on discount. So the debenture discount account will be debited with the amount of discount allowed in case the debenture has been issued on discount. So we need to mention this title over the in the second entry under the vendor account. This will be mentioned over here because ultimately we need to write off the discount, and discount is treated as expense for the company, which needs to be mentioned in the income statement later on under the expenses. So therefore the debit and credit rule explains increase in expenses are recorded as debit. So therefore we will write the discount over here if the entries are issued on discount. Similarly, in case the debenture is issued at the premium, then the debenture premium account will be generated and it will be credited with the amount of premium. Now premium is the additional amount of capital the company has earned on issuance of the debenture, which is to explain that if the 100 rupees debenture has been issued on rupees 110 to the general public or to this vendor, then we can say that the debenture has been issued on premium because it has been sold on the amount excess to the par value. So therefore under the liability section, which is to the debenture account, we will mention another additional account, which is the debenture premium account, and usually it increases the owner equity or the capital raised through the debenture issuance. So therefore we learned that the increase in owner equity or journal profit and loss account, or we can say the increase in capital reserve, has been recorded as credited. Therefore we are required to mention the debenture premium account just beneath the debenture account as credit entry. Let's take an example to discuss the issuance of debenture as a consideration other than cash. This is the illustration number 4.1 from the recommended book already informed to the students. The question says the Pioneer Company Limited took over asset of 350,000 rupees. The Pioneer Company has taken the assets of 350,000 rupees and liabilities of rupees 30,000 from gone by company. So there are basically two companies. One is known as Pioneer Company, another one is known as gone by company. The Pioneer Company is taking over the asset of 350,000 rupees and as well as the liability of the gone by company, which are 30,000 rupees, which will be paid later on by the Pioneer Company. Maybe the gone by company is trying to sell out this asset and liability as well. For the purchase consideration of rupees 330,000, these two assets and liability are going to be sold by gone by company to the Pioneer Company as a consideration of 330,000 rupees. Actually, the gone by company has sold, if we just net out the asset and liabilities, then ultimately the resultant value Pioneer will receive shall be 320,000 rupees. Because asset minus liability, the net resultant asset will left over to the Pioneer Company will be 320,000 rupees. But however, the gone by is asking for 330,000 rupees for these two asset and liability. The Pioneer Company Limited paid the purchase consideration by issuing debentures. So the Pioneer Company has not paid the gone by company in terms of cash, rather it has issued the debentures of rupees 100 each at a 10% premium. It means that the Pioneer Company has issued the debentures to the gone by company. The face value of the debenture is 100. However, the Pioneer Company has sold at 10% premium to the gone by company, which means that the 100 rupees debenture has been sold on how much premium? 10%. So if we multiply 100 with 10, the resultant value will be rupees 10. So the 100 rupees debenture has been sold to the gone by company on 110 rupees. So if the amount of any financial instrument is in excess to the face value, it is known as the sold at premium. And if the amount sale price at which the company is going to sell its financial instrument is less than the face value, then it is known as sold at discount. Finally, after understanding the data, the question is asking us to give the journal entries in the books of Pioneer Company Limited, because there are two companies. One is selling the asset and liability and the other one is purchasing that asset and liability along with issuance of debentures, not in terms of payment of, not in terms of cash payment. So the pattern for journal looks like this one. Like this one is the date column. The date is not mentioned in the question, so therefore we left this column as blank. This belongs to the particulars, that is account titles and explanation. So we can write down the particulars over here. The first right hand column is the credit column and the second last column is the debit column. So according to the rules and regulation, we need to plug or record the debit entries first, then the credit one. So what we have extracted and understood from the above question is, let me remove these inks, that the Pioneer Company has purchased certain assets. So therefore sundry asset account has been debited with 350,000 rupees and as well as taken up the liabilities of the gone by company. So therefore the Pioneer Company's liability has been increased by 30,000 rupees. So we have written in the credit column because the increase in liability has been recorded by credit. Finally, the vendor account needs to be credited, which is a temporary account gone by company limited, as we have learned from this previous slide that vendor account needs to be credited and sundry account supposed to be debited. So we have done the same. Sundry asset account has been debited, and the vendor account, which is the gone by company who is going to sell this asset and liability on the pioneer company, will be credited. If we check out the balances, the debit and credit column should be equal. So the right hand side, which is the credit column, is 360,000. However, the left hand side, which is the debit column, is 350,000 rupees. So the difference between these two amount is 10,000 rupees, and this 10,000 rupees is actually the goodwill intangible asset of the gone by company, which they were charging from the pioneer company. So therefore we will, which is the Pioneer Company Limited, include or mention an additional account, which is goodwill account and intangible asset, by $10,000, and then the smallest shortest narration, which will explain that what has actually been happened in the above transaction, being purchase of assets and liabilities of the gone by company. This was our first entry, and according to the rule we need to perform the second entry as well, which is to just write off the temporary account. As in our previous slide, we have mentioned that the vendor account needs to be written off because this was the temporary account, and a permanent nature liability account, which is the debenture account, will be developed or mentioned in the journal entry. Needs to be constructed. Actually, this is the permanent liability account, which is supposed to be constructed and written in the financial statement of the company. So we have done the same in this numerical question. The vendor account, which was the gone by company account, has been debited because in order to write off the entry, as earlier explained, the debit entry needs a credit counter entry and a credit counter entry needs a debit counter entry. So we have made this temporary gone by vendor company account. The balance was in the credit column. So in order to write off this entry, we need to mention or write down another debit entry for the same vendor account, which is gone by company account in our case. We have done the same. And then a permanent liability account will be generated, which is to the debentures account, which is the Pioneers Company liability account, which has been constructed or made with $300,000, and the additional amount, because we have sold these debentures or issued these debentures on 10% premium, the additional amount will be will go to the premium on issue of debenture accounts, which is 30,000 in this case. Now the confusion will arise that how did we calculate this 30,000 for premium and 300,000 for the debenture accounts. The calculation looks like this, that the actual consideration was $330,000 by the gone by company, and we need to complete this 330,000 rupees for the company in order to buy this asset and liability. So our company has issued them the debenture on 10% premium. It means that the rupees 100 debenture was issued to them at the rate of 110. So we have in the first step, we have divided the total consideration amount by our one debenture value in order to find out how many debentures we need to issue to the gone by company. So after division, we come up with 3,000 debentures issuance, and the par value of one debenture is 100. So therefore, we need to multiply 3,000 with the par value, and it will give us 300,000 rupees of par value. In the debenture account, which is a liability account, main liability account, we are required to mention the original par value. This is the rule of accounting for recording the journal entries for debenture issuance and as well as share issuance. So we have mentioned the par value, and the additional amount is supposed to be written in a separate account with the particular title. So in our case, it was not a discount sale, rather it was a premium sale. So therefore, once again, we need to multiply 3000 by how many debentures? The premium account, the premium value per debenture is actually rupees 10. So therefore 3000 multiplied by 10 and it will give us this 30,000 premium on debenture account. So this is the way these two accounts value has been calculated. This is the second point agenda, which is for consideration in cash. Like in previous example, we have discussed the debenture issuance in consideration other than cash. Now we are discussing the three entries, journal entries. If the debenture by the company has been issued at par, at discount, or at premium, but not for the consideration other than cash, rather in terms of cash. If the company has sold the debenture in cash, then what will be the journal entries? These are very simple and straightforward. Number one, when the debenture is issued at par, it means at its original value or the face value mentioned on the debenture, then there will be one simple entry, that is bank account, which is the company's bank account. It will be debited with the cash amount paid by the debenture purchaser or investor. It will be debited, and the direct liability account, which is a debenture account, it will be credited in the company's books of accounts. Secondly, when the debenture is issued at discount, it means that the debenture is going to be sold at the price which is less than its par value. For example, the par value of one debenture is rupees 100, and the company is going to sell out this debenture on rupees 90 only, then it will be selling this debenture at the discount of 10%. So in this case, the company's bank account will be debited by rupees 90 if the company is going to sell only one debenture, and the discount on the issue of debenture will be rupees 10, which will be once again debited in the company's book of accounts. And finally, the liability, which is the debenture account, will be credited by 100, because at the maturity, company is supposed to pay to the investor rupees 100. This is the reason that this investor is going to invest into this debenture, because at the time of maturity he will realize certain profit, which is the difference between the purchase price and the realization price, which will be realized at the time of maturity to the holder of debenture. And last but not the least, in consideration for cash, when the debenture is issued at premium, once again, if the debenture's face value is 100 and it has been sold at rupees 110, then we can say that the debenture has been sold at the premium of 10%. So in this case, if for example company has sold only one debenture, then the bank account will be debited by rupees 110. The liability of the company at the time of maturity will remain same, which is 100, the face value, and the additional amount what we have received from this investor is rupees 10, will be considered as the premium on debenture account for the company, and this premium can be transformed later on in our journal or capital reserves. And journal and capital reserves are part of owner equity, and the increase in owner equity is usually recorded as credit. So this is the reason we have recorded the debenture premium account by a credit entry, and the discount mentioned in this second entry is actually the loss to the company, and loss is a kind of expense for the company. Therefore, increase in expenses are usually recorded by debit. So we have done the same in our second entry, and the premium which will go to the journal profit and loss reserve account is is the part of owner equity, and the increase in owner equity is usually recorded as, not usually, but according to the rule, it has to be recorded by credit entry. So these are the three different entries at par, at discount, and at premium when the company is going to issue its debentures to the investors. The same entries needs to be passed in the journal. So thank you very much for listening to this lecture. If you have any question, feel free to ask. Good luck for the day. Allah Hafiz.